Hi everyone, welcome back to my YouTube channel. This is Raz, and in this video, we will discuss about deductions from gross estate, particularly the losses, indebtedness, and taxes as ordinary deductions. If you are ready, let's start. Before we can compute our estate tax, we need first to arrive with the net taxable estate. In the computation of the net taxable estate, the gross estate of the decedent shall be reduced by the items which are allowed in the tax code as amended to be deducted. These items are categorized into three. We have the ordinary deductions, special deductions, and the share of the surviving spouse. So we have here the residents and citizens and also non-resident aliens. Remember, in our gross estate, we have mentioned that residents and citizens are taxable on their properties or estates situated in the Philippines and outside of the Philippines, while for non-resident aliens who died in the Philippines will only be subject to tax when their properties or estates are located in the Philippines. Likewise, we will also categorize or classify the deductions on these decedents, whether they are residents and citizens or non-resident aliens. So we have here our three categories for the deductions. We have the ordinary deductions, special deductions, and the share of the surviving spouse. So under the ordinary deductions, we have the lit or losses, indebtedness, and taxes, which can be claimed as a deduction by both residents and citizens and non-resident aliens. Another item under ordinary deductions are the transfer for public use. These are donation mortis causa to charities, to Philippine government, to any charitable, religious, and educational institutions which are for public use or for its own purpose. And for residents and citizens, as well as the non-resident aliens, this could be deducted from their gross estate. And finally, under the ordinary deductions, we have the vanishing deduction. In our other videos, we will discuss about vanishing deduction. So for residents and citizens and non-resident aliens, they can also claim vanishing deductions. Meanwhile, under special deductions, residents and citizens may deduct a family home from their gross estate, and that is a maximum of 10 million pesos. But for non-resident aliens, they cannot deduct any family home from their gross estate because technically they are not residents in the Philippines. We also have standard deduction as under special deduction, and for standard deduction, the residents and citizens can claim a maximum of 5 million pesos. But for non-resident aliens, they can claim still, but only up to 500,000 pesos. And we have a final special deduction here, and that is the benefits received under RA 4917, which we have discussed already in our lecture about gross estate. So again, this could be claimed as deduction by residents and citizens, but not for non-resident aliens. For the share of the surviving spouse, all of them may claim a share of the surviving spouse as a deduction from their gross estate. So these are the items which are allowed by our law to be deducted from the gross estate of the decedent, whether residents, citizens, or non-resident aliens. But for this video, we will focus our discussion on the losses, indebtedness, and taxes, and we will have another video for the other items. So before we dive into our discussion, by the way, you will need to remember a few things. Number one, deductions related to exclusive properties are deducted from the exclusive properties, and deductions related to conjugal or communal properties are also deducted from those properties. If a deduction is directly attributable or traceable to a specific property like exclusive, conjugal, or communal, then this deduction could be deducted from such property. But for a deduction which cannot be traced, whether pertaining or related to an exclusive or conjugal property, then that is assumed to be a conjugal or communal deduction. Okay? So, another point to remember is that deductions which are unattributable, whether to exclusive or conjugal properties, are presumed deductible from the conjugal properties. And finally, all deductions must be duly substantiated, like what we always mentioned in our past videos, even in our income tax videos. All deductions claimed against the gross estate should be substantiated, except for one thing, and that is the standard deduction, because every decedent taxpayer can automatically deduct the standard deduction, which is 5 million for residents and citizens and 500,000 for non-resident aliens. So let us now focus our discussion on the LIT, or the losses, indebtedness, and taxes. So let us have first the losses. For estate taxation purposes, these losses pertains to losses incurred during the settlement of the estate, meaning the loss could only be deducted from the gross estate if this loss happens or occurs after the death of the decedent, but before the filing or the last day of filing of the estate tax return. It means any losses, whether incurred in robbery or theft or fire or whatever cause, whatever fortuitous events, those losses could be deducted as long as they are certified and they are verified to have been occurred during the settlement of the estate, and the loss pertains to any property which are included in the gross estate of the decedent. So here are some few things that you should remember when claiming losses as a deduction. So losses may arise from fires, storms, shipwreck, or other casualties from robbery, theft, or embezzlement, and may be claimed as deduction, provided that such losses are not compensated for by any insurance. Okay? So provided there was no insurance, or if there is an insurance, only the amount to the extent not covered for by the insurance may be claimed. And such losses have not been claimed as a deduction for the income tax purposes in an income tax return. So in our discussion in our previous videos, we have also mentioned that for income tax purposes, a taxpayer may claim losses as a deduction from his gross income. So when the loss is claimed for income tax purposes, then that loss could no longer be claimed as a deduction for the estate tax, because technically there will be a double deduction, right? Such losses were incurred not later than the last day for the payment of the estate tax. So when, by the way, the last day of filing of the estate tax return is 1 year after the death of the decedent. So when the person died on March 31, 2020, the last day for filing for the estate tax return will be on March 31, 2021. Okay, that's within 1 year. So the loss should be incurred or should have been incurred within 1 year during the settlement of the estate. So if it is incurred before the death or after the payment or filing of the estate tax, then that loss could not be claimed as a deduction. So we have here an example. Juan, married to Maria, died on February 10, 2020, leaving a total estate of 25 million pesos, of which 17 million were classified as communal properties, while the 8 million were exclusive to Juan. The following losses were incurred. So we have here 4 types of losses. Number 1, losses incurred in office building, which is a communal property, and the date of incurrence was on July 31, 2020. And we also have here personal gadgets, which is an exclusive of Juan, and which were incurred on July 31, 2020 as well. And we have here losses on vehicle, which is an exclusive property of one, which was incurred on February 15, 2021. And the amount of loss thereon was 500,000. And finally, we have here losses on the apartment, which is a communal property, and the date of incurrence was on November 17, 2020, and the loss was 900,000. So here are some additional information. The loss from office building was claimed as an itemized deduction for income tax for the year 2020, and all other losses were claimed for estate tax. Therefore, this loss of 970,000 could not be claimed as a deduction, as a loss for estate tax purposes, because this was already claimed as a deduction in Juan's gross income for income tax purposes. And another, we have the vehicle was insured for an amount of 200,000. The vehicle was an exclusive property and the loss was 500,000. Okay? Though there was an insurance recovery, but the insurance is not enough to recover the entire loss. And there was an excess loss of 300,000. Therefore, this could be possibly deducted from the gross estate. And finally, we have here apartment building, which was also insured for 400,000. And we know the loss was 900,000 pesos. Therefore, there is an excess loss of still 500,000. So in answering this problem, let's first ask ourselves, when did Juan die? Yes, that was February 10, 2020. Any losses incurred from February 10, 2020 to February 10, 2021 could be claimed as a deduction. So we know that the loss arising from the office building is non-deductible because it was already deducted for the income tax, and we could not allow double deduction of the loss. For personal gadgets, this is deductible in full amount, the 120,000, and this loss is deductible from the exclusive estate of Juan because the personal gadgets here are referred to as exclusive properties of Juan. And the loss arising from the vehicle could not be deducted. Why? Because the last day for filing of the estate tax will be on February 10, 2021, which means that the loss occurring on February 11, 2021 and onwards could no longer be deducted from the gross estate. Okay, so hence this 500,000 or the 300,000 net of the insurance could not be deducted. Also, the loss on the apartment could be deducted from Juan's communal gross estate, but only to the extent of 500,000. That is 900,000 loss minus the recovery from insurance of 400,000 pesos. And this loss, the 500,000 pesos, could be deducted only from Juan's communal estate. Now let's proceed to the indebtedness. So, indebtedness are any amount of debts which remains unpaid upon the death of the decedent. So, when you say indebtedness, basically these are outstanding obligations, liabilities, which are still unpaid upon the death of the decedent. So, this indebtedness could be classified into three categories, and they could be claims against the estate, the claims of the deceased against insolvent persons, or any unpaid mortgages and any indebtedness. So we'll start with the claims against the estate. These are the obligations of the decedent to creditors which remain unpaid upon the death of the decedent. So as I have said, these are the liabilities, obligations of the deceased person which remain unpaid upon his death. So to be valid, to be allowed, to be claimable against the gross estate, the indebtedness must be duly notarized, and if the loan was contracted within 3 years prior to his death of the decedent, the administrator or the executor shall submit a statement showing the disposition of the proceeds of the loan. Also, there must be a verification as to the beneficiary of the proceeds. And finally, in the case of accommodation only, the amount must also be claimed as receivable included in the gross estate. So when we say accommodation, this means that the proceeds of the loan is not used by the decedent himself, but is used by person or persons whom the decedent accommodated while he still lives. For example, if you are rich and you have many credit lines in banks and I want to loan something from that bank, but I could not loan from that bank because I have a low credit score, I might approach you and ask you to borrow something from that bank on my behalf, and I will be the one to pay you. So you will be the accommodation party and I will be the accommodated party. This means that you, the accommodation party, will act as the borrower. But in reality, I am the borrower and I will be the one to pay the loan. It's just that I am using you so that I can borrow something or I can borrow money from that bank because I have a low credit score. That is what is meant by accommodation. So it is said that if this loan or claims is only an accommodation, the claims, the receivable, must be included also in the gross estate of the deceased person. So let's have an example. So Juan is a resident of Pasig who died due to accident on March 25, 2021. On his death, several creditors claimed repayments for Juan's outstanding obligations, which were as follows. So we have here 4 claims against Juan's gross estate. Number 1, we have creditor Pedro, and this was used for Juan's house renovation, and the house was a communal property. This loan was contracted on July 31, 2016. That was almost 5 years ago. Okay? And the amount of debt was 1 million pesos. We also have here another creditor, and that is Maria. And the purpose of borrowing why Juan borrowed from Maria is to use for his exclusive farm. And the date contracted was just last year, September 31, 2020. We also have here loan from ABC Bank, and this was used for the hospitalization of the wife. And that was contracted just a month before his death, February 15, 2021, and the loan amount was 2.5 million. And we also have DF Bank, and the purpose of this loan was for his brother Juan. Juan is an accommodated party, and Juan here is the accommodation party. So therefore, this will still be included as a deduction from Juan's gross estate, but the 1 million here should be included on the gross estate of Juan as a receivable from Juan, because technically Juan, his brother, is the actual borrower, but Juan is so generous and he accommodated Juan, his brother. Therefore, Juan may claim this 1 million as a deduction, but at the same time, his receivable or claims or collectible amount from his brother Juan should also be added in his gross estate. Okay? Also take note that among the 4 contracts, loan contracts, 3 of them were contracted just within 3 years prior to his death. Juan's loan from Maria, from ABC Bank, from DF Bank, the proceeds of these loans should be liquidated by the executor or administrator of Juan, because these loans are within or contract within 3 years. Okay? And the law requires that if the loans are contracted within 3 years prior to his death, there should be a sworn disposition of the amount of the proceeds. Another, we have the claims against insolvent persons. These claims against insolvent person is different from the ones that we have just talked about. That was the claim against the estate. Now, in this case, this is the claims against insolvent persons. So these are the loans or obligations of a debtor to the decedent, which remains unpaid and for which the court found the related debtor insolvent. So in this case, the decedent is not the one who borrowed money, but the decedent here is the one who actually lent money to third persons, the debtors. And these debtors were found to be insolvent by the court. That is why this can also be deducted from the gross estate, because technically there is nothing to collect from these persons because they are insolvent. So for claims of the deceased against insolvent persons where the value of the decedent's interest therein is included in the gross estate. So example, Juan is a resident of Pasig who died due to accident on March 25, and again, on his death, he had several claims against debtors who still have not fully paid their indebtedness to him as follows. So we have here 4 debtors. We have John, Maria, Peter, and Luke. So John here is still capable of paying, therefore this will not be deducted. Maria here is found to be insolvent by the court, therefore the 300,000 here is deductible. Peter here is nowhere to be found, but it is not said whether he is insolvent. This could be subject to litigation. Okay? There was still no decision from the court, therefore these claims cannot be allowed as a deduction from the gross estate because he is not found to be insolvent. He's just nowhere to be found. Okay? And Luke, on the other hand, is asking for payment extension. So Luke here is actually not insolvent. In fact, he's just asking for the extension of the payment terms. So therefore, the only thing that could be deducted from Juan's gross estate as a claim against insolvent person is only the 300,000 by Maria, because Maria was found to be insolvent. However, when computing the gross estate, the 4 of them, the 500, 300, 700, and 400, should be added to the gross estate. Okay? But only the 300 could be deducted from the gross estate. And finally, under indebtedness, we have the unpaid mortgages. So unpaid mortgages or any indebtedness shall be limited to the extent that they are contracted, and for an adequate and full consideration in money or money's worth. So again, as a requirement, any indebtedness should be notarized, and the mortgage, if this is a mortgage, should be valid and still subsisting. Okay? And this should be lawful. And for unpaid mortgages in respect to a property, the value of the decedent's interest therein must be included in the gross estate undiminished by such mortgage or indebtedness. So for example, if a decedent has this real property, let's say for example his house and lot, and this was subject to a real property mortgage, then the unpaid balance of that mortgage upon the death of the decedent could still be deducted from the decedent's gross estate, provided that the fair value of the property of the real property owned by this decedent wherein that mortgage was attached should be included in the gross estate of that decedent. Okay? For example, the gross estate of Juan, who was a married decedent, was 3.5 million, wherein 820,000 was inherited from his mother who died 4 years ago. So we can say that out of 3.5 million, 820,000 here was an exclusive property because that was inherited from his mother. The inherited property, which was 820,000, has an unpaid mortgage of 200,000 pesos, whereby 60% of it was already paid during the lifetime of Juan. Therefore, out of 200,000, there's still an unpaid mortgage of 40% of the 200,000 pesos. Therefore, the remaining unpaid mortgage, which is 40% of the 200,000, or that is 80,000 pesos, may be claimed as a deduction against the exclusive gross estate because the mortgage was related to the property which was inherited, and that inheritance is actually classified as an exclusive property. Also, the mortgage is deductible from the exclusive gross estate of Juan. Okay? So after we have discussed losses, indebtedness, now we go to taxes to complete our discussion on the lit. Taxes may have accrued but not paid as of the time of death of the decedent. Let's say, for example, the decedent died on January 10, 2021. And we know the filing of the income tax for last year, 2020, will only be on April 15, 2021. Therefore, the income taxes from last year were already accrued prior to his death, but only paid after his death, right? So therefore, those accrued and unpaid taxes could be deducted also from the gross estate of Juan. However, there are some rules that we need to consider. So, the following taxes are non-deductible. Number 1, income tax for income received after death. So any taxes, any income taxes which are related or pertaining to the incomes received after death could not be claimed as a deduction as taxes from the gross estate of the decedent. So, for example, just what I've said a while ago, for those taxes already incurred or accrued last year but only paid later on after his death, that could be deducted. But for future incomes, for the taxes, income taxes for future incomes after his death could not be deducted from his gross estate. Second, property tax not accrued prior to his death. So, and of course, estate tax. Because essentially, we are still computing for the estate tax. You cannot deduct something like an estate tax beforehand where we are still computing for the tax, right? We have here our final example for the lit. Juan married, died on January 2, 2021 with few unpaid taxes below. So we have here 4 types of taxes. We have income tax for Juan's net income in 2020. The due date of the tax would be on April 15, 2021. So therefore, this tax could be deducted from Juan's gross estate. Why? Because this tax was already accrued last year, right? But only payable on April 15, 2021. 300,000? Check. Next, we have property tax. And this real property tax of Juan, which is an exclusive property, by the way, this tax is for the year 2021. And Juan died on January 2, 2021. Therefore, this tax could not be deducted. The property tax should be accrued and unpaid prior to his death. Okay? But since this for the year 2021 onwards, current, non-deductible. We also have percentage tax for Juan's 2020 fourth quarter sales. So, even though this percentage tax was already accrued last year, final quarter, which was payable only on January 25, 2021, but we cannot deduct this one. Why? Because percentage tax is related to Juan's business, to Juan's sales. Okay? So therefore, this percentage tax should be deducted as an itemized deduction for income tax purposes and not for estate tax purposes. Okay? We also have here estate tax for Juan's taxable estate, and the due date will be 1 year after his death. So he died on January 2, 2021, then a year after would be the deadline. And again, we cannot deduct estate tax. So from these items, only the income tax, the first item, the 300,000, can be deducted from the gross estate of Juan. Okay? So that's it. Thank you so much for watching, and I hope you learned a lot from this video. We will have another video for the other ordinary deductions from the gross estate. Okay, so if you love this video, give me a thumbs up, and if you're new to this channel, please subscribe, click the bell so you'll be notified whenever I will upload new videos. Bye!